Hey, welcome back everyone. So we're going to be looking at Crocs as they just had their earnings for Q1 2022 and just kind of reviewing just some of the basic stuff there and seeing how they did. So first off, they beat earning estimates, and I'm not really too surprised about this. With adding a new brand into their fold, the Hey Dude brand, I don't think they wanted to overestimate when it came to guidance for Q1. Plus, with supply chain issues that had been going on and are still going on for pretty much most companies out there, and increased cost, it's no surprise that they were careful with where they treaded for any guidance. But let's talk about it. They beat the EPS estimates by almost 32%. They also beat the revenue estimates for the quarter by about 6%. So it's a beat in both areas that people always tend to look at. So that's a good thing. Now, if you'll join me on the screen here, we're going to go over just a few things from the presentation. First quarter revenue was a growth of 47% on a constant currency basis. Now, we do need to give some context to this. Yeah, it's like 47% growth. But what's not being mentioned here is that's based on growth with the Hey Dude brand that they have now. And if you're comparing to last quarter 2021, Q1 versus Q1, which is where we're at, they didn't have Hey Dude. So this is with Hey Dude, and it's 47% growth. If you look at just Crocs alone, as if Hey Dude was never acquired, it's closer to 20% growth, which is still really, really good growth. What I do like here is now that you can kind of see that they've let things settle with Hey Dude for a quarter, the Hey Dude brand, and I think they're more confident about how they can perform as a company with them included. Now they're saying they're confident to raise full year outlook for revenues to approximately $3.5 billion. Now, of course, if you compare that to 2021's revenue of about $2.3 billion, it's not going to be entirely fair for a comparison because, again, they didn't have the Hey Dude brand yet, which is bringing revenues up. But not for nothing, they're guiding for overall revenue increase year over year from 2021 to 2022 of about 51.5%. Which is insanely good. Now on this next slide here, you can see what they were talking about. Revenue was roughly $666 million for this quarter, with the Hey Dude brand included, and that put it in the 40s for an increase. But if you look at just Crocs revenue, it was closer to 20%. Crocs alone was $545. Hey Dude at $115 million. Now on this slide, they go over 2022's full guidance in a little more detail. And you can see for Q2, quarter two of 2022, we've got overall revenue estimates of 918 to 957 million, where Crocs is a range of 718 to 737 million. And Hey Dude, 200 to 220 million. Now, I just want to explain how they're having Hey Dude especially go up a pretty good amount. If you look at the revenue that was posted for Hey Dude, it actually should have been, quote unquote, a little higher. But remember, Crocs did not have Hey Dude for the entire quarter, which is why it didn't include basically all of that revenue from them for the full quarter, because they didn't have them fully acquired yet. But you can see compared to Q1's 545, Crocs is really increasing their estimates here for quarter two. That typically just has to do with, Crocs is doing very well with how they're selling no matter what time of the year it is now. It's really becoming a recognized brand and doing very well. However, you have to realize that, there are seasonal times where certain companies will do a lot better, and Crocs is no different. When you're looking at a quarter two, they just tend to sell better seasonally during that time slot. And so they are guiding for Q2 anywhere from 718 to 737 million in revenue for Crocs alone, which again, we'll go ahead and put here, would represent a 20% growth. Okay, everyone, that's pretty much all we're going to go over in terms of their presentation. I could have gone a little more in depth with the numbers, but I didn't really feel the need to. I just want to see how they do in the next quarter, and if they can meet these sort of raised guidance expectations that they put forth. Just for reference, I ran a DCF model on Crocs before. I'll link in the description for it. But essentially, Crocs is a company, has this 5-year plan where they're going to get to $6 billion in revenue overall between both brands. And I did a stock calculation based on that. And with Crocs growth assumptions to getting to $6 billion in revenue by, I believe it was 2026, a calculated stock price came out to $182, which is a really great return from these numbers. However, let's keep in mind, normally when I like to run these models, I don't go entirely by what the company is saying or even guiding, although it's kind of nice to look at and keep in your head. They think it's worth that much in the future, which is, and worth right now 182 based on that revenue estimate into the future. But I ran a more conservative model that goes based off 10% revenue growth rate year over year, which I think is so conservative for them and is so easy. Based on how they've been performing, so easy to meet those expectations. My calculated stock price based on 10% revenue growth rate over the next 5 years was $117 a share. Either way you slice it, I think that this company is severely undervalued right now. Very, very undervalued. And I gotta be honest, I kind of laugh when I've seen other YouTubers talk about this company. I'm not gonna mention one in specific, but essentially, there was a particular channel saying, I think they're crap. I don't care if they look undervalued or if I think they're overvalued. I think they somehow calculated they were overvalued, which is just, if you run the numbers and run a DCF model, it's impossible to look at Crocs and think that they are overvalued. But at the time they were saying, I think it was around 100 a share, they were saying, this is way overvalued and I just don't get the brand. I hate it. All right, well, sometimes, first of all, when you're making investments, you look at the numbers first. But it's also good to like the brand and like the company you're investing into. I guess I get why this individual would say that. You don't want to invest in something, even though the numbers are proving you wrong. You don't want to invest in something you don't believe in. But in terms of providing analysis for other people watching your content on YouTube, it seems a little silly to basically be like, I don't understand this company, so therefore I just don't like it and don't recommend it. A lot of people are very silly with that. They're like, I don't see anyone wear Crocs. Well, where's the $545 million for this quarter coming from? And a fair majority of that revenue comes from the US, North America. Where's that revenue coming from if people hate it so much and you don't see anyone wearing them? Personally, I see people wearing them all the time. I work in a hospital and some of the employees wear them. I see our patients wearing them all the time. We personally at home have 5 pairs of them. I thought they were the stupidest thing. So I think it's a thing of being idiotic that you weren't willing to try it yourself. Because I thought they were the dumbest thing all throughout high school. I'm like, God, people wearing those look so dumb. But now we have 5 pairs at home, and they're the most comfortable thing I have ever worn on my feet. So to be able to invest in a company that I not only believe in now, but the numbers support it, and I think they're very undervalued. I mean, for my personal investment, it's a no-brainer. You also have to take into account that Crocs does have like a worldwide presence of sorts. They're not just sold in America. Okay, we're not going to drag this video out too much longer, but yeah. I didn't run another DCF model because I'm very comfortable with the one I ran before. 10% revenue growth rate over the next 5 years gives us a calculated fair value of about $117 a share. And again, if you go by management's estimates, they're estimating like closer to 20% overall revenue growth rate into the year 2026, which puts it at a fair value based on the DCF I did before. Again, link will be in the description. About 182 a share. Either way you slice it, I think that Crocs is undervalued. Based upon the model I did, Crocs is undervalued. And based upon the numbers, Crocs is undervalued. And again, management is very confident now and has raised full year guidance to about $3.5 billion. Okay, let me know your thoughts down below on Crocs. Is this a company you are invested in? Are you looking to invest in them? Because to be honest, they had an insane run up. And don't get me wrong, they had a great 2021 year. They had an insane run up for 2021 where they, in my opinion at the time, looked overvalued. I think they ran up to like 180 a share. Even after these earnings, I think they're like in the upper 60s or maybe low 70s now. I mean, I just think they're insanely undervalued. But let me know your thoughts down below if you think they're undervalued. If you think that Crocs is overvalued, let me know why down below. Do you own any shares of this company? Are you looking to buy shares? So let me know all your thoughts down below in the comments. And that's all I've got for you guys. So I will see you in the next one.